Holy flippity flip flop flap and smokes, everyone. This is an emergency urgent broadcast. We have just got some huge, massive news, people, and when I saw this news, I nearly fell off my chair. Ladies and gentlemen, what we're in right now, we're in the eye of the storm. We're at the beginning, and it has just started today, of a global financial crisis. We are seeing currencies collapse, like the euro, the pound, the Australian dollar, the yen, the yuan. We are witnessing the worst bond market crash of our lifetime. We are seeing record inflation, and if we used to go off the way they would record it in the 80s, would actually be at 17 or 18% inflation, which would actually be worse than the 70s and the 80s. But a lot of the data is being manipulated. Seen $9 trillion wiped out of the stock market already. House prices around the globe are starting to crater, and we have just got news that there's been emergency intervention in the bond market in the UK. The Bank of England has had to step into the bond market right when interest rates were skyrocketing uncontrollably, because if they didn't step in immediately, we would have seen the whole financial system in London seize up. And remember, London is a huge financial hub for the world, so whatever happens in London, we need to pay attention. And people, things are not looking good at all. So everyone, this is a very important update, so let's not waste any time. Let's get straight into the news, the facts, and the data. Look at this, everyone. Bank of England intervenes in bond market after massive sell-off. Now, people, I want to show you a chart here. This is a chart of the UK 10-year yield. They call it gilt, so that's just another word for bond. This is the yield on their bond. Now, just a month ago, it was 2.8%, but we've seen over the past month and more recently this week, yields or the interest rates on these bonds have skyrocketed uncontrollably, and it hit breaking point today at 4.5%. And it would have gone much higher if the Bank of England, UK central bank, didn't step in to stop the pain. But unfortunately, it may be too little too late, because there is much more economic pain and much more headwinds coming for the UK at the moment, which is going to have massive consequences for the rest of the world, like the US and Australia. London, the Bank of England will suspend the planned start of their bond selling next week and begin temporarily buying long-dated bonds in order to calm the market chaos unleashed by the new government's so-called mini-budget. Another temporary government program. I think we all know what happens to these temporary government programs. They tend to go on a lot longer than expected. And you may be wondering, okay, so what caused all this? Well, what caused all this? Inflation is skyrocketing out of control in the UK right now. Look at this. Even with fuel prices falling, UK inflation is still 9.9%. And we're seeing a massive energy crisis in the UK. We're seeing the government come out with new crazy tax cuts. They're giving massive tax cuts. They're not doing very targeted tax cuts to people that really need it. They're just giving tax cuts for everyone. They're also bailing out a lot of these energy companies, and they're spending a lot more money. What they're doing is they're literally throwing more fuel on the fire for inflation. So what this means is these investors don't want to buy these government bonds. They're only paying 4.5% when inflation is around 10%. They're going to be losing money. So they're starting to demand a much higher interest payment. But unfortunately, the UK government can't afford to pay this high interest. So we're starting to see the central bank have to come in as lender of last resort. Yields on the UK government bonds, known as gilts, were on course for their sharpest monthly rise since at least 1957, as investors fled British fixed income markets following the new fiscal policy announcements. The measure included large swathes of unfunded tax cuts that have drawn global criticism, including the IMF. Did you hear, everyone? This is the sharpest increase in interest rates since 1957. This financial crisis that we're in right now, and this global recession, which will lead to a global depression, is going to be much worse than any recession we've experienced in our lifetime. And I think it is going to rival the Great Depression. And why is that? That's because the governments have not fixed any of the fundamental issues from the last recession. The answer to every single recession is lower interest rates and print more money. But unfortunately, they've already lowered interest rates to zero. And they've printed so much money, now inflation is out of control. And people, like I keep saying, they only have two decisions. Either hike interest rates to bring inflation down, or keep printing money, which is looking like what the UK government's about to do, but unfortunately, that's going to lead to their pound getting pounded. In an emergency statement Wednesday, the central bank said it was monitoring the significant repricing of the UK and global assets in recent days, which has hit long-dated UK government debt particularly hard. And people, it's not just the UK central bank monitoring this. Janet Yellen has also come out recently to say she's monitoring the situation as well, because this does have global implications for everyone. Just like when the US had their financial crisis in 2008, it was felt around the world. If London experiences a financial crisis, again, they are a major financial hub, we're going to feel pain around the world as well. Again, as we see here, Yellen says she's monitoring UK developments after pound plummets. The central bank said were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability. That's exactly right, everyone. Here, the central bank is admitting it. They're admitting that they are in a financial crisis, and if they don't step in now, if they don't step in right now, this financial crisis is about to get the lid ripped off. This would lead to an unwarranted tightening of financial conditions and a reduction of the flow of credit to the real economy, the Bank of England said. Translation, that would make interest rates go to the moon. In line with its financial stability objective, the Bank of England stands ready to restore market functioning and reduce any risk from contagion to credit conditions for the UK households and businesses. Again, they're admitting something else here. This has contagion effects. It's contagious. What happens to some financial institution which has a lot of debt or has a lot of connection with other financial institutions around the world, this has the ability to spread to other businesses, other banks, and impact other households. Now, so we know that the UK government is throwing fuel on the inflation fire, but what has caused this inflation? Well, it's been caused from central banks around the world buying government bonds and buying mortgage-backed securities, aka printing money and throwing fuel on the inflation fire. Well, the Bank of England is about to throw in some TNT in there as well. As of Wednesday, the bank will begin temporary purchases of long-dated UK government bonds in order to restore orderly market conditions, and said these will be carried out on whatever scale necessary to soothe markets. People, what we're witnessing here is the emperor has no clothes. We are witnessing how weak these markets have become. We've gotten to the stage where if countries or central banks lift interest rates by 2 or 3%, we start to see the markets implode, because the only thing propping them up is low interest rates and money printing, cheap debt, free money. And as soon as that gets taken away, well, we're seeing right now the markets literally collapse. And they said here they will do whatever necessary. They don't care how much it's going to cost. They don't care how much currency they're going to have to print. They will do whatever necessary. They'll buy every single bond on the market in order to keep this market functioning. Does that sound like a free market to you? Does this sound like a real market where there's literally no one wants to buy the debt? Nobody wants to buy these assets, so they have to get a central bank to print money out of thin air in order to buy these assets to keep the government on their debt binge. Doesn't sound like it to me, everyone. And they'll actually meant on Monday next week to start selling bonds, but they've already scrapped that plan before they even started. The Monetary Policy Committee target of an annual £80 billion or 85 billion US dollars reduction of its gilts, aka bond holdings, remains unchanged, the bank said, with the first gilt sales initially slated for Monday. Of course, they're now saying we're going to take place on October 31st. And we'll see if they kick the can down the road again. A spokesperson told CNBC immediately after the announcement that the bank's first priority for now had to be the functioning of the bond market, suggesting that the worst outcome would be for the sovereign to be left without market access and unable to secure financing. And that's exactly right. If the Bank of England didn't step in, the government wouldn't be able to raise funds and they could risk getting a credit down rating or even default. So what we have in England is a very dysfunctional market. You have the Bank of England trying to cool inflation by lifting interest rates, and then you have the government taking on huge amounts of debt. Now, normally central banks are meant to be independent and not finance government borrowing, but unfortunately it doesn't look like this is the case here. It's looking like that the government is borrowing and the central bank is having to come in there to save the day to finance this government's debt. But people, it's not just this. Look at these other huge developments that is happening in the UK right now. Look at this. UK lenders halt mortgage deals to customers after market chaos. So what's happening with a lot of banks and lenders right now is interest rates is rising so fast. For example, they could offer a mortgage to a customer and they maybe give them a pre-approval for 2 to 3 months, or maybe they'll give them an offer, and literally the next month interest rates are nearly double. So they're having to cancel these deals, cancel these mortgages and reprice them to the market because prices are going up so rapidly, aka interest rates. Virgin Money and Skipton Building Society temporarily pause mortgage offers for new customers, while Halifax, owned by Lloyds Banking Group, is planning to hold any mortgage products with fees where lower lower interest rates are usually offered. Households refinancing a 2-year fixed rate mortgage in the first half of next year will see their monthly repayments jump to about £1,490 early next year, up from £863 when they took on the mortgage 2 years prior. So that is an absolute massive increase, people. This is nearly doubling their monthly mortgage repayments. And this is not just happening in the UK. This is happening in the US. This is happening in Australia. People are about to see their mortgage repayments absolutely balloon, and this is only the beginning. The developments not only mean that mortgage prices are set to increase, but borrowers are likely to have less options. A series of small lenders have reportedly already halted mortgage product sales over the last few months due to pressure of rising rates narrowing the market. And we're seeing this in the US and Australia as well. We're seeing these lenders, all these mortgage brokers, they're going completely bust. We're seeing massive layoffs, and I think we're going to see more and more of these mortgage or these lenders, these small lenders, go down. But you know something even more alarming? Look at this, everyone. UK supermarket default risk surge near record on the pound sell-off. The risk of debt defaults for British supermarkets surged on Monday as investors reacted to the wild market swings sparked by tax cuts that many fear will fuel inflation. This is very worrying, everyone. We're already seeing the food supply hit massively with huge increases in fertilizer costs, with drought, with a coming famine, and with prices rising so rapidly, these supermarkets are losing money. Insurance bonds on the UK supermarkets Asada Group Ltd and Iceland Foods Ltd, used to protect investors against non-payment, jumped to signal a 52% and 76% chance of default within 5 years respectively. For Asada, that marks the highest on record, with Iceland just shy of an all-time high set when the pandemic struck. This is very worrying, everyone. When you're seeing 76% chance of grocery stores, supermarkets going bust, that's how bad you know the real situation is. British supermarkets have already been hit hard by rising costs and Brexit-related supply chain shocks, while cost of living crisis threatened to squeeze British household budgets, and fears of soaring inflation were stoked further on Friday to cut taxes and ramp up borrowing. And now investors are factoring a 60% chance that Iceland will default on its bonds within 3 years. So everyone, I know what you're thinking, okay, what does all this economic jargon mean for you in simple terms? What this means is markets are starting to malfunction. Nobody wants to buy these government bonds, so we're seeing central banks have to step in to save the day. This is going to make inflation worse. We're going to see more companies, as interest rates skyrocket, go bust. We're going to see more lenders go bust, like what's happening in the mortgage market right now. And what this could cause is a short-term pause on central bank lifting interest rates, but what this will lead to is inflation going massively higher, and then they're going to have to panic, and they're going to have to do what Paul Volcker did and have to lift interest rates to 10 or maybe even 15% to bring it down, and it's going to make the situation much, much worse. But everyone, that was just a quick update. What do you think about all this craziness that is going on? I literally can't keep up with the news. Let me know in the comments below. Thanks for watching. I'll see you all in the next video.